What is counterparty risk?
Basel II and counterparty credit risk.
From the Basel II Compliance Professionals Association, BCPA, the largest association of Basel II professionals in the world.
According to the Basel II framework,
the counterparty credit risk is defined as the risk that the counterparty to a transaction could default before the final settlement of the transaction's cash flows.
And economic loss would occur if the transactions or portfolio of transactions with the counterparty has a positive economic value at the time of default.
This is different from credit risk through a loan, where the exposure to credit risk is unilateral.
The counterparty credit risk creates a bilateral risk of loss.
The market value of the transaction can be positive or negative to either counterparty to the transaction.
The market value is uncertain and can vary over time with the movement of underlying market factors.
Basel II, credit risk. Counterparty is used to denote a party to whom a bank has an on- or off-balance sheet credit exposure, or a potential credit exposure.
The framework allows banks to offset credit or counterparty risk with collateral, guarantees or credit derivatives, leading to reduced capital charges.
Basel II and counterparty credit risk, CCR. The bank must have counterparty credit risk management policies, processes and systems
that are conceptually sound and implemented with integrity, relative to the sophistication and complexity of a firm's holdings of exposures that give rise to CCR.
A sound counterparty credit risk management framework shall include the identification, measurement, management, approval and internal reporting of CCR.
The bank's risk management policies must take account of the market, liquidity, legal, and operational risks that can be associated with CCR,
and interrelationships among those risks.
The bank must not undertake business with the counterparty without assessing its creditworthiness and must take due account of both settlement and pre-settlement credit risk.
The board of directors and senior management must be actively involved in the CCR control process
and must regard this as an essential aspect of the business to which significant resources need to be devoted.
Where the bank is using an internal model for CCR,
senior management must be aware of the limitations and assumptions of the model used,
and the impact these can have on the reliability of the output.
They should also consider the uncertainties of the market environment, timing of realization of collateral, and operational issues, pricing feed irregularities, and be aware of how these are reflected in the model.
In this regard, the daily reports prepared on the firm's exposures to CCR must be reviewed by a level of management with sufficient seniority and authority to enforce both reductions of positions taken by individual credit managers or traders, and reductions in the firm's overall CCR exposure.
The bank's CCR management system must be used in conjunction with internal credit and trading limits.
In this regard, credit and trading limits must be related to the firm's risk measurement model in a manner that is consistent over time and that is well understood by credit managers, traders and senior management.
The measurement of CCR must include monitoring daily and intraday usage of credit lines.
Banks must take account of large or concentrated positions, including concentrations by groups of related counterparties, by industry, by market, customer investment strategies.
The bank must have a routine and rigorous program of stress testing in place as a supplement to the CCR analyses.
To learn more, and to continue to learn month after month, join the Basel II Compliance Professionals Association. Membership is free.
I hope you will join us. You may leave any time. We will respect your privacy. Thank you.